Anyway, Paul Mattick from Mercia. I can probably do most of it without slides. So I was a bit under scrutiny here. Seems we've got reviewers and IFAs and now a fund manager, and it seems like the last two speakers have set me up very, very nicely for to go through a process and try and be chastised at the end. Effectively, what I wanted to run when this is possible is to show you that the sort of things that we recognise, that the fund manager recognises that you need to see from your due diligence point of view, so for the reviewer or IFA wants to see from the fund manager, but also then looking at the due diligence which we do onto the investee companies. So we are an early stage technology investor, have 337 million under management, and that's growing quite quickly. We have capital from various different pools, ranging from government money, so we run some of the regional growth funds. We also have pension capital and EIS and SEIS capital. So we're quite a well-established company. Mercia originally was set up in the 1980s, and it's been evolving over the last 30 years, and we've been built, especially the last kind of 24, 36 months, it's built to something quite substantial, and excellent. We got there. So I think we can probably skip through the first few things. So I'm talking on this at the moment. So set up in the 80s. Our top co is actually AIM listed, and it's around 125 million market cap. So it's a sort of entity that someone can look at and look into in some depth. So from a DD point of view, when you're looking at Mercia, you should be able to see all the way through it, hopefully. You can see, if you want to look at the annual report, you could actually see the CEO's salary, that sort of level of transparency. So that's the thing which actually is quite important, because I think for other managers, EIS managers, it's a very opaque situation where you put your money into basically a dark pit, and it comes out, hopefully, at the end with some appreciation, and the EIS tax certificates come along the way. As I say, we run various different pools of capital from government, regional growth funds, pension funds, university endowments, all sorts of different pots of money. Quite a big company, 60 plus investors, investment staff and support staff, 6 offices. It's actually more like 8 at the moment and growing quite quickly. Deal flow, this was mentioned by Mark. So a lot of the points that I was going to bring up was mentioned by Mark in his presentation, and that's not a bad thing for me at all. So deal flow is one of the obvious ones, and we'll come on to that later on how we deal with it. Personally, Mercia is a regional investor. We do this for value. So we see a lot of capital being deployed into the southeast. So on this report, it's about £3 billion coming into the southeast, into early stage technology, whereas the rest of the country's got £1 billion. So we think there's some value to be had outside of the southeast. We have a number of offices and university partners spread across the Midlands and North. So 18 universities on the left, but we have actually most of our deal flow, we'll go on to the details, actually comes from our investment directors' networks. So it's their commercial experience which is more relevant for our deal flow sources. So we have a big university partnership, but most deals come through the investment directors into 4 sectors, and we'll come on to why those 4 sectors in a minute. Our model is to be able to fund companies from very early stage all the way through. So we can do grants, even very early stage grants. We can do seed, so CDIS, which may not be appropriate for your clients, for IFA's clients. But and then we talk about going to EIS, growth capital, and hopefully to the exit. For each stage, we have different pots of capital we can use. So grants, we can supply. We don't do many of them, but we can. It tends to be university spin-outs. Then we can provide SEIS capital, tends to be from private investors. EIS coming in from IFAs normally. Our top co, which is wholly owns Mercia Fund Management, can then provide its balance sheet capital, which means these little technology companies of different sectors can come to us, and they can keep getting capital from different sources at different stages. So we can put 5 or 10 million from the balance sheet. Actually, if needs be, we can deploy larger amounts. If our institutional shareholders want to participate, we can deploy larger amounts than that as well. But that's attractive from a company's So there's lots of different types of due diligence. So obviously the reviewers, so we have various people who reviewed us. So we've got Alan Bridge, MyCap, Harbin. Harbin's obviously the best, that's why they're here today. It was a very good process. But they're quite keen to look at Mercia, but from a company point of view, and we'll come on to why in a minute, this is very interesting for a company. So if a little tech company wants to grow really big, has great ambitions, seeing that we can provide a full range of capital means that they don't need to go elsewhere. So we're not going to guarantee to fund them all the way, but if they do well and they keep hitting their targets, we're likely to provide follow-on capital. And that's something which makes the company's due diligence on us, they look at us and think that's quite an attractive partner, a funding partner. But and the exits, yeah, they come. It does take some time. Early stage tech is one of the areas which, yes, 5-7 years is realistic. In some cases, more.
Do all your investing companies end up getting some support from Topco balance sheet?
No. So it's very selective. It's got to be on their own investment decision. So Mercia Fund and Mercia Tech are separate entities in their investment process. If the Mercia Fund company is doing really well, Mercia Technologies will look at it. Their board will decide whether they'll invest. They are separate entities, and that's one of the risks, which it's obviously an intrinsic risk.
So do some go straight from EIS to exit?
Yes.
And where you do get involved at Topco balance sheet level, what's the dilutive effect to it?
Well, obviously, Topco doesn't want to dilute the fund too much because that's providing a deal flow. So it tends to be on relatively friendly terms, the valuation which Topco invests at. It is external, but obviously they're not going to bite off the hand that gives them deal flow. And there is a relationship there, which again we'll come on to. So, EIS industry, in overview, you'll know this already, as asset-backed or low risk, or whatever you want to call it, limited life, and then there's technology companies. This is fundamentally changing towards the more growth EIS over the last couple of years. Solar panels being taken off qualification. This is all something we all know. The thing I want to focus on is the diversification. So with asset-backed, low-risk EISs, yes, so you could potentially have one company, maybe a project finance, maybe 2 or 3, and be relatively secure, just because these companies are inherently not that likely to fail because they've got long-term cash flows, contractual revenues, etc. But so diversification in that situation, maybe not so relevant. When it comes to technology companies, these are especially early stage tech, they will fail. There will be a proportion of companies which will fail, and it depends what percentage is subject to how good the manager is in stock selection and active management. I mean, on the board, your involvement, the risk mitigations you put in place to try and avoid the company going bust. But from our point of view, we actually want some of the companies to go bust because it means that we're investing at the right stage early enough to get a really high return. If some other AIS providers and technology spaces, it's far more concentrated. So you might have 3 to 7, say 3 or 4 companies, and if one of them goes bust, then that has a massive impact on your portfolio. And yes, there's loss relief, and you get tax reliefs as well. But as Mark said, and Wilma said, it should be about an investment rather than just about tax reliefs. And that's something which the HMRC is progressively moving the industry towards. So 3 to 7, is that diverse enough? We don't think so. We create quite broad early stage technology portfolios of 15 companies around there, and hopefully within that you'll see 2, 3, 4 who actually do really well. And then there'll probably be a similar number within 3 years that probably fail. And then the rest, over the next subsequent few years, you'll see how the portfolio splits. And ultimately, there's going to be either successes or failures. There should be no zombie companies, and that's something which the industry needs to avoid, but we do see happening quite a lot, which is the dark pit in which money goes in and doesn't come out. But so we create broad portfolios, and this actually has so far we're seeing at least 1 or 2 companies, normally 3 or 4 per fund, which are doing 3 to 5x. So decent multiples on cost. So fine. What is more important here is more about our deal flow, and you want to know a bit about what the reason I'm presenting actually is how we look at these portfolio companies and our due diligence process on the companies in which we are investing into. So creating that broad technology company portfolio. Those 4 sectors you saw briefly earlier on. The reason we focus on those 4 sectors, so life sciences, digital, software, which is everything, and advanced engineering effectively, is because of our 4 investment directors who are experts in those areas. They are commercial guys who have sold companies for 50 million, that sort of level, or the CEO of Sega. So they know these industries really well, and they can do their own, and they don't even need to do due diligence because they already understand the sectors with such depth. They can see inherently that's going to be a good company. We'll look at that. We'll maybe move it slightly, or we'll help that company introduce. So there's a lot of value we can add there. So we do bring in external consultants where required to do DD for us in specific sectors, but we like these areas because we know them, and that's our own DD. Going from the left to right, don't ignore the words on the left at the moment because they're so small it's ridiculous. Per company, per year, we see around, at the moment, about 2,000 companies, opportunities, and that's growing quite quickly. The exact number is, it's varying on a week-by-week on a rolling basis, but it's going up quite quickly. It was 1,600 when we quoted it last annual report, and I think it's actually closer to 2,500 at the moment, but there's strong reasons for that, and I'll mention that later on. But basically, we have a very precise DD process and investment protocol. We have from the point of inquiry through to investment, at the summary level, 1% get through. So we invest about 20 companies for Mercia growth funds each year, and coming around from 2,000. So there's 99% just stripped away in that process. And most of it actually is in the initial few phases, and we'll go through the phases in a minute. After that, we have the ability to deploy follow-on capital, as I mentioned, and from the balance sheet. And hopefully, the plan is to get all the companies to exit either a write-off or a good exit. That's the plan. On the right, there's those very small words, and this is the deal flow sources. We'll run through, especially, again, we'll focus on number 3, the investment directors' networks, because that's where we see the majority of our deals coming from. And that, I wouldn't be surprised if that's a bit of a surprise to you guys, because we have university partnerships. We have quite a few of them. But obviously, these are very early companies. There's university spin-outs, there's seed, the EIS, and they take a bit of coaxing, a bit of work on the board. But we also have other sources. So we have coming directly to us. We see quite a few companies who just pitch to us, and I get emails every day saying, this is an idea, does it work, would you invest in it? Some of them are spammy, but in fact, a lot of them are spammy, but some are real ones. But they don't tend to be high quality approaches. So the highest quality is from the investment directors' networks and our investment team more broadly. We can also invest alongside some of our other funds, which we manage. So we manage regional growth funds, which is the Northern Powerhouse. We've got £108 million to invest in the north, which is great. And that we have the ability to deploy EIS capital alongside that, which means if we've already invested in the company, we can see some DD at first hand by sitting on the board. So, but the regional incubators, yeah, that does provide some deal flow. Advisors, so corporate finance especially, we get a decent amount of introduction from corporate finance, but the corporate finance and investment directors, that they are our main quality sources. So 2,000 companies come through. Right, this is quite a lot of detail on the slide, hence the sequential. So when we first received the proposition, we would first do a call or a meeting, probably with maybe 50%. So there's a big chunk which is taken out before that. If they're not in our space, if they're too late stage, so we have some quite strict requirements. just to get to even the first step. So out of the 2,000 that arrive, probably 1,000 get to that top step, because if the valuation is too high, that's normally the problem, to be honest. We won't invest in anything which has got a higher than 5 million valuation to start with. We then follow on with capital subsequently. So probably top line, 1,000 companies get to that stage. Meeting, call, see if they fit with investment criteria, just digging a bit more to see if they actually do, rather than just the pitch deck we looked at. Then meet the whole company, especially CEO, CTO, just to make sure that they're credible. So we invest in people ultimately, because ideas are, yeah, they're fine, but serial entrepreneurs are something which is really valuable. They know what mistakes they have made previously and they avoid them. And that's something the UK is not as good at as the US, certainly. So meeting the management team is really, obviously, it's pretty important for us because we're very active investors. Go through the business plans in detail, and this is something which, of course, the DD, that's a pretty basic part of DD, and we have some very sophisticated guys who with all sorts of different qualifications and running through those business plans, financials. Right, then making an offer, that can take a while, and lots of negotiation around that price point, and that's the valuation tends to be one of the sticking points. That's what we do. We make sure we're coming in early and then follow. Then go into some more detailed DD, and DD can easily take 3 months, and from point of first engagement to cash in the bank. And that's the kind of timescale that we would expect from any approach to us. That's the timescale is realistic. We can do it quicker. We can do it, if we're not sure, we'll do it a bit slower and look at the company, see how they progress. But it's looking at the entire scope, really. So looking at going from the different contracts, and then for more detailed assessments, the strategy, the regulatory environment, M&A. So the whole scope of the company. And so we get really close to it. And with the guys who are already in the sectors, they can do that quite quickly and easily. Then legals can take a while as well, especially with complicated EIS and all the regulatory changes and action. So, and then obviously then there's completion, fine. Actually, the thing that's always forgotten is ongoing support, but that's something which we are really big at, is we get on the board and we get active. And that is actually probably one of the best elements of due diligence, is we put small amounts of money in and then sit on the board and look at them and see how good they are. And if they're good and they're hitting their targets, we will follow. And I think having some cash in the business is one of the best due diligences you can get from our point of view. And it means that we might risk a small amount, but then we can follow on with some more substantial amounts. Good example, this is one of the companies that in our portfolio. So what Mike Hayes I mentioned earlier on, he's the ex-CEO of Sega. He saw this company and thought that's a good gaming company. He decided to invest a small amount of money, put 250k in from EIS Capital, and he basically pivoted the company into augmented reality, virtual reality, which is going to be the future 2-3 years ago, and now it is. And it's coming on, and you're seeing lots of releases, and they're right at the forefront of this. So Mike's had a massive amount of value to the board. But more than that, Mercia has drip-fed capital with them, and this one, the balance sheet, has invested and built out our position quite substantially. So from Dream's point of view, working with us was great, because we had both the value add from Mike Hayes, but also the ability to follow on with capital. Quickly go through this, because this is ultimately what people want to see. Is DD is all about, in the end, both our DD and external panel and reviewers, is about performance and exits. It's about returning cash to investors. We've had quite a few funds and some successes. This is especially, actually, this point down here. So our funds are doing reasonably well. They're early stage, and this is unquoted, so past performance is not a reliable indicator of future returns, etc. But there's good uplifts and across the EIS funds. But having cash back, starting to have cash back just after 3 years, I think that is something which not enough people would show. There's very few fund managers I think we'll publish this on their website, and I think more should. And if they're not, you've got to, as Mark was saying, why aren't they? They should be, because they want, you should be able to show this and live up to your performance. And that's one of the things that reviewers do, is they can dig through this and they can actually present this in a standard way across different companies, different fund managers, and that's really valuable for both the IFA, for us as well, actually. But getting that cash back is the point, and the only way to get cash back is either stock market listings or trade sales, M&A, and we actually have another mechanism, but I'm not going to go into that. But just a couple of examples: we sold a linear. Actually 26x in December for the fund, 21 for the balance sheet. So this is a company in which the balance sheet followed on. We've got 21x selling to ARM. And then, in fact, we had an even bigger partial sale recently, in which this company is in a very high, fast-moving space and robotics. It listed on AIM last year, just over 12 months ago. It's currently valued around 585 million. We own 15%. We've already taken out 13 million from the company. We only put 1 million in the first place. So this obviously is the sort of thing that every fund is looking for, and that having some track record, having big exits, or the ability to deliver big exits, is something which is very important, both from a DD point of view, from the reviewers and IFAs. Seeing those sort of returns, hopefully, is what you guys are looking for. But DD, from us, as I say, that there is lots of different types of DD. There's a company that does DD on us to make sure they want to work with us. There's our DD on the company. But then, of course, there's the IFAs and the reviewers that due diligence on Mercia. And we have, let's say, reports from Allen Bridge Hub and MyCap at the moment. And I think they form an integral part of the industry. And I just want to thank both actually Mark and Harbin for being here and presenting alongside me. And I think from that, I am done.